Deven Choksey, Managing Director at Deven Choksey FinServe on the show. And Deven, hi, morning. Thanks so much for joining us. What are you making of the sector churn that we're seeing in the market? Earlier in the show, we were talking about how we're seeing a comeback from IT, metals. On the flip side, realty seems to be entering a cycle of sluggishness now. Would you agree with that? And what are you making of this entire sectoral churn that we're seeing?
Hi, good morning. Well, I do not know whether it is sluggishness, but I do agree with one thing that the markets are basically moving with the rotational preferences. Suppose if the RBI had brought down the rate of interest to infuse the liquidity to CRR cut, most of the banking stocks have started finding themselves in the favor, also from the perspective of momentum. And as a result of which, I think some of the other ones who are not catching up with this momentum, I think they are getting less preference, which is justified. This market remains by and large a market where I think higher amount of momentum-based trading activity is happening. Also because of the fact that I think valuations are otherwise reasonably priced. They are more or less, I think, discounting FY27 earnings from the perspective of I think whatever the earning growth we are experiencing currently. I guess I think till 27, the most of the stocks are fully priced in. And as a result of which, I think the markets, because of the liquidity as well, is basically showing higher amount of, I think, the churn, higher amount of rotation in the portfolios of the investors. Maybe I think that it's a way to operate this market. And in any such kind of situation, when individual stocks they become corrective or they provide, I think, the opportunity in the price corrections, I think that becomes a buy opportunity in my viewpoint, and that could include some of the select ones, be it in the area of metal and commodities or be it in the area of auto and ancillaries as well, where we remain distinctly confident about the growth prospects going forward.
All right, so that's the take on the markets. Select pockets are looking good as of now. But Deven, also help us, what do you really make out of the oil and gas space? The reason I ask this, because select counters have been doing well, and especially MGL, after the analyst meet and the key takeaways, it's a 7% jump in yesterday's trading session. What's your sense on the space overall, and any specific take on MGL?
So we are not so bullish about these companies, particularly because I think they're driven significantly by some of the variables which are not in control of companies. For example, I think the gas price. For example, the government policy controlling the gas price. I think we ourselves do not find very comfortable with this particular space at all because of the smallest factor could possibly affect the business of these companies. Having said that, I think from the utility perspective, these companies have created a significantly large amount of distribution points with the end consumer, be it on a B2B side of the activity where they would supply to the bulk consumers like gas stations, and otherwise, I think this is being supplied to the pipe gas to the consumers in general. So, in my viewpoint, I think both B2B, B2C models definitely existing, distribution points well connected. The fact remains that I think dependent significantly on the government policies, and that's where we are not very confident about putting a confirmed recommendation or confident recommendation.
Right. Deven, there was a lot of panic in the market yesterday with regards to what happens to an Eternal, what happens to a Swiggy now that Rapido is venturing into food delivery. But we've seen in the past that the battle's won by the cash rich. So how do you think this entire situation is going to plan out, and what it would mean for the likes of an Eternal and Swiggy?
I think you touched upon a very important point. I think the cash reach, I think in your conversation, I believe that I think while we are talking about Eternal, we are talking about Rapido, we are probably, I think, undermining the big elephant sitting in the room, which is JioMart. They have already started the deliveries without charging the platform fees, whereas the likes of Blinkit, likes of Swiggy's and the Zomatos, they do charge the fees, I think, on multiple instances. Be it from the customer, they charge the platform access fees, or be it from the hoteliers, I think, for whose food they are supplying, or even for that matter, other areas in which I think they are operating. I believe that I think this is going to get significantly challenged with the players like JioMart, who are having a significantly large amount of cash rich abilities to counter this kind of players in the marketplace. At the same time, I think most of these companies, from investment perspective, when you look at them, I think they are actually putting at a fancy valuations. Given the fact that I think they have been succeeding with the price hike and the charges, I think that I think these fancy valuations might get affected if the competition like GeoMart would start penetrating faster and could possibly create disruption with that. So let's see how it goes, but not very comfortable because of the valuation also at the same time.
Okay, so that's the take on the entire quick commerce space. But Kunal, today we have a report that's come on Grasim from Morgan Stanley, wherein they've upgraded.
Do you see the sector moving ahead, and which are your top favorites?
Well, I think from looking at the private sector companies, I think they have been thriving on the product innovations. They have been thriving on the high value-added product at the same time, and also adopting the digital approach in expanding the market reach. So the acquisition of a customer, the cost of acquiring a customer remains comparatively lower in their case. So I think given that situation, I would think that they deserve to be premium ranked, which they are currently. The embedded value to EBITDA, the main ratio that we look at in life insurance case, I think remains pretty comfortably high for some of the private insurers compared to the LIC. In my viewpoint, I think the growth momentum is expected to continue for a couple of reasons. One, the income tax has new income tax exemptions have started coming in this financial year, wherein the tax rates are not likely to apply till the amount of income which is about 12 lakhs. And that's where probably higher amount of surplus remaining in the hands of individuals, which would possibly find its way into some of the financial products, including the life insurance. In this kind of a scenario, the private sector companies remain relatively more favorable from the growth perspective, also because of the fact that their base is something giving them an advantage at this point of time. Whether I think we would immediately buy into some, answer is yes and no both. Valuation wise, some of them have already started scaling up, though we find good potential in likes of SBI and HDFC Life, and also of course the Bajaj life insurance business. So we like those businesses from investment perspective.
SBI Life as well as HDFC Life. These are the stocks to watch out for, and yes, of course, the momentum that we are seeing in these counters are backed by a strong data. But other than that, today all eyes will be on Tata Motors as well, because just yesterday we highlighted some of the key takeaways from their analyst meet, and on that, brokerages have come out.
Pharma space. This is a sector that has not been spoken about, given that we've seen some return of some moves coming in IT. Metals are doing well. It's of course banking and financial that's stealing the limelight. But what about pharma amid all of this? It's been steadily gaining with the market momentum, but I believe the market is, not factoring in the big overhang that's still on pharma, that is tariffs. So what are you making of this space?
That remains uncertainty for sure. I think till the time we get the full clarity on it. But leave that aside for a while. I think how Indian companies are strategizing their presence, I think, across the globe. On one side, I think they are bringing out the specialty generics, the complex generics that you want to call it as. Some of the large companies like Sun Pharma, Cipla, Dr. Reddy, among others, are the ones I think who are registering their presence with these complex generic drugs, which is giving them the advantage of the pricing power. The lever is very, very strong as far as I think the pricing is concerned on this particular drugs, because they are not competing with the pure generics. So that is a positive going for them, and most of these companies are expanding their portfolio on that side. Second positive which is going in is the API business, I think, which is again very comfortably getting merged into the formulation business, some of the global peers, the large pharma companies, and again Indian companies, including the likes of Divi's, Laurus, and even the other majors who are basically having no relatively small component of the sales, are having presence in the API segment as well. So that also remains comfortable. And last but not the least, I think on the margin front, because of the input cost scenario remaining on an improvement side, most of these pharma companies are basically seeing a better margin in the current financial year vis-a-vis the previous years. So we remain distinctly confident about the prospects going forward, save and except this particular turbulence of tariff, etc. Once that gets out of the way, probably some of these companies could get re-rated from the current levels.
All right, so that's the view coming in on select pharma stocks. But Deven, with this, we let you go on that note. Thank you so much for taking the time out and speaking with us this morning. But with this, let's move on and let's also get you some of the tradable ideas from